So welcome back from lunch. Greetings, my name is Joshua Blank. I'm a professor here at the law school and the faculty director of the graduate tax program. On behalf of the tax program, I would just like to thank KPMG for sponsoring this great event now in its 15th year. This event is really one of the highlights of the year for us. It allows our faculty, our students, tax practitioners from the New York community to consider timely international tax topics from both theoretical and practical perspectives. I'd also like to just take a moment to thank Larry Pollock from KPMG for his tireless efforts in making this event happen. I believe this is the only international tax event with a violinist who takes requests as you wait to go into lunch. Maybe somebody will correct me if I'm wrong on that, but that's all due to Larry. Also this morning at 8:15 a.m. as we were waiting in line to register, Larry came over to talk to me because he wanted to let me know he's thinking about the topic for the 16th annual NYU KPMG lecture, which will take place in the spring of 2016. So we're deeply grateful for all of your efforts and for the support of KPMG to NYU Law School. It's wonderful to see so many members of our alumni community and the greater tax community here today. We closed the registration at 500 for today's event. And I just wanted to quickly mention that if you're enjoying today's program, I hope that you'll come back and participate in some of our other programs, including next week. Next Thursday, April 30th, from 8:30 a.m. to 1 p.m., we will co-host with the Amsterdam Center for Tax Law a joint conference on cross-border investments and other tax issues for hedge funds, REITs, and RICs. In addition, next Friday, May 1st, from 6 to 8 p.m. at the law school, we'll host a special tax alumni reception as part of our reunion weekend, and we hope that any of our tax alums who are here today can join us for that event. You can find out about both of these events on the NYU Law Tax blog, and hopefully you're receiving emails from us for those of you who are part of the alumni community. It's now my pleasure to introduce our Dean, Trevor Morrison, to you. Trevor is the Dean and Eric M. and Lori B. Roth Professor of Law here at the law school. During his first 2 years as Dean, he's brought incredible energy to the law school and has been very supportive of the tax program. In addition to his role as our Dean, he's one of the leading constitutional law scholars in the United States. He has deep expertise in constitutional law as practiced in the executive branch, a topic maybe which is relevant even for today's discussions. So please join me in welcoming Dean Trevor Morrison.
Thanks, Josh, and welcome everyone. This is a terrific event here at the law school, and I'm just really pleased to be here to be able to join and welcome you to the 15th annual NYU KPMG lecture. Now, one of the most important principles in faculty discussions of anything is that it may be the case that everything has been said, but it hasn't been said by everybody. And so embracing that principle, let me echo Josh's thanks to KPMG and to Larry Pollock in particular for working with us these many years and continuing this spectacular event. Larry, thank you so much. I also want to take this opportunity to welcome back to the law school many of our graduates of the graduate tax program and the international tax program. These programs are real flagships of the law school. They are jewels in the crown, to be sure. This is a very exciting time for tax at NYU. We are a leader in online legal education because of what we do with our tax program, offering the LLM in tax online as well as in person. And in the last year, we've launched a new master's for experienced accountants and other financial professionals, drawing on the expertise of our tax faculty to teach tax law to non-lawyers. We're really committed to maintaining the stature and preeminence of our tax programs. We believe that the tax program here really is second to none, and that's something that I, as Dean, am committed to making sure continues. And one of the ways in which the program has achieved its stature is through the participation, enthusiastic support of our tax alumni base. We really rely on our alumni to teach as members of our adjunct faculty, to speak on panels and some of the events that Josh was referring to, and to mentor our current students and recent graduates. So you, the alumni of the graduate tax program, really are the heart and soul of the program, and you distinguish us from all other programs. So I want to thank you for your support for the program and for the law school more generally. And finally, I want to thank and to welcome our keynote speaker, Mark Mazur, who's the Assistant Secretary for Tax Policy at the Treasury Department. Thank you, Mark, for being here today, and I'll turn the microphone back to Josh, who will formally introduce Mark. Josh, thanks.
Thanks very much, Trevor. So it's my pleasure to introduce our keynote speaker, Mark Mazur. Mark Mazur is the Assistant Secretary for Tax Policy at the U.S. Department of Treasury and was confirmed by the Senate in August 2012. Before his confirmation, he was the Deputy Assistant Secretary for Tax Analysis in the Office of Tax Policy. He has deep experience in the federal government. He was formerly the Director of Research Analysis and Statistics at the IRS. He served in various positions, including at the Joint Committee on Taxation, the Council of Economic Advisors, the National Economic Council, and the Department of Energy. Before entering public service, he was an assistant professor at the School of Urban and Public Affairs at Carnegie Mellon University. He holds a PhD in business and a master's degree in economics from Stanford University. Please join me in welcoming Mark Mazur.
Thanks, Josh. Appreciate it. Good afternoon. I want to thank the organizers and especially Hank Gutman from KPMG for inviting me here today to participate in this incredible event. And I want to thank Josh for the kind introduction. He left out part of my bio that is important, that I was my undergrad's from Michigan State University, a Final Four team. So just... The Office of Tax Policy has benefited from and continues to benefit from a number of NYU Law School graduates. And I appreciate the opportunity to spend a little bit of time here today with you all, and especially the students and alums, some of whom hopefully one day will come work at the Office of Tax Policy and contribute to the success of the office. I also want to note that I have the great pleasure to work with one of your faculty, Lily Batchelder, who's currently on leave at the President's National Economic Council. I really want to thank the faculty administrators here at the law school for lending her to us and letting her share skills with us for the last few years. When the President gave his State of the Union address this year, he referred to the concept of middle-class economics. And he made the point that the U.S. economy as a whole does better when everyone can envision themselves participating in the benefits of economic growth. And when the President described his vision of middle-class economics, he highlighted several policies. He talked about community college that would be affordable, generally free, and accessible to all who worked hard and maintained good grades and made progress toward a degree. He talked about a higher minimum wage for some of the hardest workers in the American economy. He talked about various improvements to the individual income tax system, including greater support through tax credits for working parents, for child care, and for those attending college. And the President also mentioned business tax reform. And he mentioned using some of the revenue that could be, some of the temporary revenue that could be generated from business tax reform to make needed investments in infrastructure. Now, it's obvious how community college access plays into improving the lives of those in the middle class and the lives of those aspiring to become part of the middle class. Throughout the 20th century, the United States led the way in providing broad-based education opportunity. As we continue to the 21st century, our nation needs to aim higher with respect to educational attainment, to provide our workforce with the skills needed to contribute and thrive in a changing economy. And economic research has shown that more education is associated with improved economic opportunities. The administration wants to ensure that all Americans have a robust set of opportunities to succeed in the 21st century U.S. economy. And so that's how you can tie together middle-class economics and education, the thrust for additional education for our workforce. It may be less obvious how business tax reform fits into the construct of middle-class economics, but that's exactly the case that I want to try and make today. And I want to explain how reforming the tax rules that we apply to multinational firms, the international tax system, can also be a significant part of middle-class economics. So first, let's start with why the nation needs business tax reform. Most observers would agree that the business tax system today is inefficient, it's overly complex, perhaps, maybe not perhaps, too riddled with loopholes and special provisions. So really it can't function as a world-class revenue-raising tool. And if we want to maintain a vibrant corporate income tax as one of the components, one of the tools in a portfolio of revenue-raising tools, then we should reform it. As you all know, and you probably heard earlier today, the U.S. has just about the highest statutory rate in the world, statutory corporate tax rate in the world. After the 1986 Tax Reform Act, the United States corporate rate was 34%. And at that time, the U.S. was relatively a low-tax country with a 34% rate, while other rates around the world ranged in the 50% range. So compared to our major trading partners, the U.S. was relatively low-taxed in a corporate tax sense. Now, if we fast forward 3 decades, we see that just about every one of our trading partners significantly reduced their maximum statutory tax rate. They changed their portfolio of revenue sources, a little more toward consumption tax, a little less toward corporate income tax. And were able to reduce their corporate tax rate. While in the United States, the corporate income tax rate ticked up from 34 to 35% over that time period. And so while the U.S. rate has crept up a little, other rates around the world have gone down, and the U.S. now is viewed as a high tax country compared to our trading partners. And this disparity in corporate income tax rates provides some bad incentives for U.S.-based multinational firms. These firms have very strong incentives to shift income abroad, to shift production abroad, to shift investment abroad. And similarly, multinational firms based elsewhere, but with significant U.S. operations, have strong incentives to shift deductions into the United States and to shift income to lower tax jurisdictions. So they get a deduction at the relatively high U.S. tax rate, claim income at a relatively low foreign tax rate. And the IRS, as tax administrator, is constantly pushing back against these tendencies. If we had a chart of OECD tax rates, the disparity would be obvious. We'd see on the, I guess, the left-hand side, the lower end of the spectrum, we'd see Ireland, Slovenia, Finland, and the UK, rates of 20% or less. And then we'd see at the right-hand side, the high-tax side, we'd see the US and Japan with rates approaching 40% when we add in state corporate income taxes. And the effects of this disparity in rates showed up in a big way last spring and summer. There were a number of planned or carried out corporate inversions. The cartoon of a corporate inversion that I like to sketch out is a larger US-based multinational firm merging with a smaller foreign firm, maybe in the same industry, maybe a rival, and adopting the domicile of the foreign firm. So for tax purposes, the combined firm is largely treated as a foreign firm going forward. Even though very little of the operations have shifted, really is largely just a shift of tax address. The administration last fall took some steps to slow the pace of inversions. We issued a notice that reduced the economic benefits accruing to inverted firms, and these steps seem to have reduced the pace of inversions, reduced the pressure, at least a little bit in this area, and provide some time for Congress to deal with this issue, hopefully through business tax reform. But the high statutory corporate income tax rate in the international context for the United States belies the fact that when we look at effective tax rates, that is, taxes paid divided by income, the U.S. is not an outlier. In fact, if you look at the G7 countries, the United States effective marginal tax rates are probably right in the middle. I think they wind up like smack in the middle between France and the UK. And so it indicates that the U.S. has a high statutory tax rate, but sort of a middle effective tax rate, And the reason for that is that we have, in our tax system, many special deductions, exemptions, credits, and other provisions that lead to a lower rate on average, even though the marginal tax rate can seem quite high. Overall, the effective tax rate for U.S. firms averages around 27%. But that average masks a wide range of differences depending on the industry. For some industries, construction, finance, wholesale, retail, the effective tax rate's over 30%. For other industries, companies in mining, transportation, computers, electronics, the effective tax rate's less than 20%. So we have this disparity depending on the industry that a firm is in. And while these effective tax rates are just summary statistics, there are summary statistics that indicate we have widespread non-neutralities in our business tax system. And these non-neutralities impose economic costs and make the business income tax system less efficient than it could be. In a similar vein, one of the largest non-neutralities or distortions in the corporate tax system relates to the choice of financing. Given the deductibility of interest payments and at the corporate level and entity level taxes on investments financed by equity, there's a gap in the effective tax rate between debt-financed investment and equity-financed investment. And in many situations, accelerated depreciation plus deductibility of interest leads to negative marginal effective tax rates on debt-financed investment and substantially large positive rates on equity-financed investment. So this large non-neutrality can bias decisions in favor of debt finance, and it can get to a point where excessive leverage imposes additional costs on a firm that's engaged in this, or potentially even larger social costs on the economy as a whole. One other area where the business tax system introduces distortions is the choice of entity. Effective marginal tax rates are higher for investments undertaken in corporate form compared to investments made by non-corporate entities. And business activities have shifted to reflect this differential. In the early 1980s, about 85% of business revenues were generated in the corporate sector. Since that time, we've had loosening of rules regarding use of S corporations. We've had state laws that have promoted the increased use of LLCs. We have taxpayers who've gotten more comfortable with large-scale partnerships with many thousands of partners. And all of these have led to a situation today where around 60% of gross business receipts are attributable to corporations. So there's been a migration from the corporate sector to the non-corporate sector. And this rise of non-corporate businesses then has eroded the corporate tax base in the U.S. We've seen a rise in the number and scale of flows through entities, from master limited partnerships to very large S corporations, to real estate investment trusts. In the case of REITs, we have them being spun off out of corporate entities to manage assets that traditionally have been part of corporate systems subject to corporate income tax. But perhaps the most wide-ranging use of flow-through entities to erode the corporate tax base takes place in the area of international tax, where a strategic choice of entity plus uncoordinated international tax rules leads to situations where multinational firms create what Ed Kleinbart has called stateless income. That is, income is subject to a tax nowhere in the world. Or perhaps in a somewhat less extreme case, subject to nominal levels of tax in jurisdictions whose rules help facilitate that outcome. This use of flow-through entities exacerbates the concern I raised earlier, where the relatively high U.S. corporate tax rates provide an incentive to shift income to other places and to shift economic activity abroad. Because in the case talking about the corporate tax rates, we were saying, well, the U.S. rate's around 35%, rates in the UK maybe 20%, there's a 15 percentage point differential, that's kind of a big differential. But if you take into account the possibility of stateless income, where income is not taxed or very low taxed, then you're looking at a 30 percentage point differential or more, and a much larger incentive to shift income, and obviously a much larger potential returns to activities like tax planning and financial engineering. One other area of non-neutrality involves actual investments in particular types of assets. Under the U.S. tax system, the effective marginal tax rates are highest on land and inventories, lower for structures which claim depreciation, lower still for equipment which can claim additional accelerated depreciation, and lowest effective tax rates for intangible assets, where really the cost of developing these tends to be immediately expensed. So this quick overview points out several non-neutralities that are contained in or distortions introduced by our business tax system. They include differential rates depending on where income is earned or deemed to be earned, much lower effective tax rates on debt finance investment than equity finance investment, lower effective tax rates for investments made by flow-through entities than by corporations, differential tax rates depending on industry, differential effective tax rates by type of assets. And all of these distortions impose costs on our economy and costs on our tax administration system. And many of these distortions are a direct result of complexity in our tax system. Now, the President's plan for reforming the business tax system in a revenue-neutral way would lessen these distortions, so take these wide gaps and shrink them somewhat, and provide a measure of simplification for business taxpayers. And these benefits would reverberate throughout the economy. The President started the ball rolling with a call for business tax reform contained in the February 2012 release of the President's Framework for Business Tax Reform. And there are three things you should just take away from this name. One, it's the President's framework. The President was personally involved in decision-making and has a degree of ownership in this framework that's different from what it would be if it was just a Treasury white paper that we released from our office. Second, it's a framework. It was intended to provide room for dialogue on tax reform with business leaders, academics, members of Congress and their staffs, other stakeholders. Many details were intentionally not fleshed out in the 2012 version to foster a dialogue. And the plan focused on business tax reform, which is broader than corporate tax reform. And this reflects the fact that steps taken to broaden the base of the corporate income tax system will almost surely broaden the base for non-corporate businesses as well. Moreover, the focus on business tax reform also underscores the desire, to the extent possible, shrink the distortions that relate between choice of corporate entity, or corporate entity versus non-corporate entity. Now, the President's framework enunciated several important principles. First, and probably most important, business tax reform should improve the climate for retention and creation of high-quality jobs in the United States. We all know tax reform is a big lift. We know that political capital should be invested in this activity only if there's a substantial payoff to improving the workings of the economy, in particular to improving the lives of middle-class Americans. Second, business tax reform should be revenue neutral in the long run. This means that about the same proportion of revenue, tax revenue, should be raised under reform as would be raised without it in future decades, as well as in the 10-year budget window. So very roughly, if the corporate tax system raises 2 or 3% of GDP today, that same percentage would be raised going forward. And the President's been clear that the nation faces fairly large budget concerns in the longer term, didn't want business tax reform to make that situation worse. And just as an aside, it's a big deal for a president from the Democratic Party to actually propose business tax reform. It's not exactly an issue that the Democrats have run on. It's not part of the traditional Democratic platform. But it is an opportunity to reach out and get something done in a bipartisan way. The President's framework would broaden the tax base in numerous ways, reduce the statutory corporate rate to 28%, which would be within shouting distance of our important trading partners. The framework would strengthen international tax rules, take away the ability of firms to use tax engineering to shift profits abroad, and would reduce the incentive to shift real investment and jobs abroad. The framework would provide permanent tax incentives for activities with important spillover benefits. And a poster child here is the R&E credit. Many studies have shown there are large benefits associated with increased research activity that are not captured by the firm that undertakes that activity, and so there's a good rationale for providing an incentive for government to provide an incentive to encourage that activity. The framework would seek to simplify the tax code where possible, and permanent tax incentives that were included in the reform system would reduce uncertainty for firms going forward, and also tax compliance could be simplified, especially for smaller firms, through things like expanded expensing and expanded cash accounting. And finally, the framework would not raise taxes on small businesses in the aggregate. This is just a recognition that from a political standpoint, it's not possible to have a tax cut for larger businesses financed by a tax increase on smaller businesses. Now, this framework has been elaborated on several times. So it started as a framework in the fiscal year 2014 budget, fiscal year 2015 budget, fiscal year 2016 budget. It's been expanded upon. And really, the budgets have laid out a lot more detail to give an indication of what a fully fleshed out plan would look like. One observation that the president made was that a business tax reform plan that was revenue neutral in the long run would almost surely generate substantial revenue in the short run, in the 10-year budget window. And in prior tax reform efforts, that transition revenue, that temporary revenue, is used for transition rules, essentially to provide special benefits to taxpayers who are affected by reform to ease the path to the reformed system. What the president has done is propose that a portion of these temporary one-time revenues be used to finance infrastructure investments, which would benefit businesses and help grow the economy in the long run. And this is an important part of the president's plan, in that infrastructure investments would create construction jobs that would provide an important boost for middle-class Americans, and that these important investments would pay dividends for decades to come. And the opportunity to pay for a long-term reauthorization of the Highway Trust Fund through business tax reform has attracted a fair amount of congressional interest, providing a noticeable boost in the prospects for enacting business tax reform in this Congress. Now, in the fiscal year 2016 budget, the administration provided significant detail about the international components of business tax reform. And the goal was to put forth a coherent plan for taxing multinational firms that would address some of the distortions that I mentioned earlier, and also provide a roadmap to a modernized, competitive international tax system. The international proposal can be thought of as being comprised of three components. One component is the future tax system for multinational firms. This would address concerns raised by multinational firms about cash management and their desire to redeploy earnings of foreign subsidiaries without unnecessary tax obstacles. A second component would be a set of beefed up international tax rules to address aggressive tax behavior and address some unintended consequences of current tax law. The basic goal here is to reduce the role of tax planning that does not reflect the underlying economics of the activity that is taking place. And the third component would be a transition tax on a stock of unrepatriated earnings that U.S. multinationals have built up over the years. This stock reflects the relatively high U.S. corporate tax rate, which acts as a disincentive to pay dividends from low-tax foreign subsidiaries to the U.S. parent firm. But this stockpile of earnings also reflects a facet of financial accounting rules, which treat the earnings of foreign subsidiaries that a firm claims are permanently reinvested as not being subject to U.S. tax for book reporting purposes. And this provides then a vehicle for U.S. multinational firms to boost their book earnings and earnings per share by declaring that these earnings are permanently reinvested abroad. And since financial accounting results drive a lot of behavior among CEOs and other corporate executives, this accounting treatment has been a large driver of the result. So let me dig into the components of the international reform in a bit more detail, starting with the hybrid system for multinational firms. This has features of both so-called territorial system or exemption system and features of a so-called worldwide system. The hybrid system that's laid out in the budget would feature a global worldwide minimum tax of 19%. So that earnings of US-based multinational firms would be subject to some level of tax regardless of where the income was earned. The proposal would permit a tax credit for a portion, 85% of foreign taxes paid in a country. So the 19% rate both acts as a floor to help prevent a race to the bottom in tax rates. And it provides with a foreign tax credit, provides a situation where for high tax countries, or relative high tax countries, the tax paid by the foreign subsidiary would be the last dollar of tax paid on those earnings. After the global minimum tax was paid, the multinational firm would be able to move its cash resources throughout its organizational structure, something that many multinational firms have said they desire because it makes good business sense. The global minimum tax also features an allowance for corporate equity to permit limited amount of earnings by active businesses to be exempt from the minimum tax. This recognizes that some sorts of activities with routine returns need to be located in specific places due to market concerns or other economic drivers. The poster child here would be something like a hotel in Bermuda, which needs to be located in Bermuda. It cannot be a hotel in Bermuda being located somewhere else. And so the regular returns on hotels would be exempt from the global minimum tax, but any additional returns would be deemed to be earned by intellectual property or some other intangible asset, and so would be subject to the minimum tax. Now, it's important to strengthen the rules governing international taxation. So the administration recognized this in the President's Framework for Business Tax Reform. Since then, the G20 leaders have recognized that problems of multinational tax avoidance impose costs on many countries, and they tasked the OECD with updating model tax rules in what's called the Base Erosion and Profit Shifting, or BEPS project. What we did was take some of the work that was being done at OECD, some of the work that we've seen done in Chairman Camp's proposals, and try to build upon them and build out a set of international tax reforms that we proposed in the FY 2016 budget. One of the proposals would eliminate the use of hybrid entities and hybrid securities to create stateless income. Hybrid entities are treated as corporations by one tax jurisdiction and treated as a partnership or some other disregarded entity by another. Hybrid securities treated as debt by one tax jurisdiction, treated as equity by another. And these different tax treatments can be and are arbitraged by tax planners. What the proposal would do is make the future tax treatment reflect the underlying economics and rights, responsibilities possessed by the security entity, and based on really the economic factors, not so much on the form that these take. The budget proposal also would reduce the ability of firms to undertake inversions. It's important to realize that no matter how low the U.S. tax rate gets, it'll still be higher than some other countries. And so really we'll need to have some sort of a break on inversion activity, and the budget proposes some rules in that regard. The budget also would update transfer pricing rules to better reflect what unrelated parties would do in setting prices for goods, services, and property transfers, and really focus on potential excess returns to intangible property. The budget would also update rules associated with the digital economy to better account for local provision of needed marketing and other ancillary services. The goal is here to assure that income from digital services is taxed somewhere, and that the jurisdictions involved have some clear idea of what their taxing rights are. The budget would also strengthen rules to prevent earnings stripping out of the United States. One particular technique, interest stripping, is singled out for special attention, and the proposal would limit interest deductions to a pro rata share of interest expense based on worldwide debt equity ratios, or to limit it to fraction of earnings before interest, debt, depreciation, amortization, and taxes. And really what this is designed to do is to prevent situations where firms disproportionately load up their U.S. operations with debt and then make intercompany loans to siphon some of those earnings out of the United States. So those are the way we beef up the international tax rules. The final component of the international tax module would be a transition tax that's imposed on existing unrepatriated earnings. There are about $2 trillion of earnings of foreign subsidiaries of U.S. firms that have not been subject to U.S. tax. And this transition charge is intended to get at that. The administration's proposal would be for a 14% tax to be levied on the stock of unrepatriated earnings. And these are earnings that were accumulated over a period of years when the U.S. Corporate tax rate was 34, 35% or possibly higher. And against this backdrop, a 14% rate seems equitable. Some would probably would say maybe even a bit of a bargain. And the tax would be offset by a proportionally reduced foreign tax credit, the resulting liability paid over 5 years. And this lengthy payout period is meant to recognize that some firms have liquidity constraints and may not be able to pay a relatively large sum of tax in a short period of time, but by spreading it out over a period of years, it should be manageable. After the transition tax was paid, then the firms would be able to freely move these resources throughout their enterprise, deploy them wherever they made the most sense from an economic standpoint. So all these reforms are aimed at reducing distortions in the tax system. And taken together, they should lead to a better allocation of capital so that the underlying economics drive the allocations, the investment decisions, and not the tax system. They should lead to increased certainty for taxpayers who want to make long-term investments, whether it's in tangible assets or something like research. It should lead to less emphasis on debt, and which could reduce the overall leverage in the economy, and then have a knock-on effect of reducing challenges to financial and economic stability. We could have better, with the reform, could have better international tax rules to ensure that countries don't feel they need to compete in a race to the bottom by lowering their rates to try and attract businesses. We could have a reform system with lower compliance costs and a smaller role for financial and tax engineering. And we could have all this done, as shown in the President's plan, in a fiscally responsible manner, one that does not burden future generations with additional debt. Now, if we, that is, administration and Congress, can pull this off, the economic benefits will accrue broadly throughout the economy, supporting a broad middle class. And by pairing business tax reform with a plan to increase investment in badly needed transportation infrastructure, will multiply the economic benefits accruing to those in the middle class and to those aspiring to be in the middle class. Now, I'm a bit of an optimist on the topic of tax reform. I think the fundamentals for tax reform are as good as they've been at any time since the 1986 Tax Reform Act. That doesn't mean tax reform is a certainty in this Congress. The politics still are not great, and politics can still get in the way. But it does mean there's at least a possibility of bringing this to a successful conclusion. And you probably won't have to wait long to find out. Given the upcoming presidential election next year, significant progress ought to be made this year in order for there to be a chance of enactment. And by this year, you probably mean early summer, because the legislative process won't be going on till December or later to get this enacted into law. We have an opportunity to take advantage of upcoming reauthorization of the Highway Trust Fund as sort of an action-forcing event for Congress to pay some attention to business tax reform. And so there is at least a way to thread the needle and see how this can come together. So I urge you all to stay tuned to the upcoming debate on business tax reform. I urge you to contribute to that debate in whatever form you think is most sensible. If we succeed in reforming the business tax reform system, we'll all be beneficiaries. Well, maybe that is except for tax planners and financial engineers. Anyway, I just want to thank you all for your attention today. I really enjoyed spending some time with you, and I'm really looking forward to the debate for part of the program, so thanks.